Hi and welcome to DNB Carnegie in our interview with Fingerprint. My name is Markus Almerud. I'm an analyst here at the bank. I got with me Adam Philpott, who's CEO. Hi, Adam.
Great to be here, Markus.
So you released Q3 earnings this morning. Maybe starting out with revenues. You grew revenues in constant currencies by 47%. And let's say market growth is some 20% or so. Maybe some color on what's driving growth, where are you growing, what areas are growing, etc.
No, good. So, I mean, I try to break the business down into cylinders, because that way we have good balance across the business. Not everything is always performing at exactly the same time. There's a bit of lumpiness. And so there's a couple of ways that I would look at those cylinders. The first way is through our transformation plan. So we have asset monetization opportunities that we pursue, we have core business opportunities that we pursue, and we have new business opportunities that we pursue. I'll ignore business modernization. That's more about cost and efficiency for now. So, I look at those as I think about those cylinders. Good performance from asset monetization, particularly in Q3. We had a strong piece of Aegis business. And that's what we look for, a balance across those things so that at least one of them is performing on a given quarter. The other way we look at it is, of course, geographically as well. So we have strong business in the US, in Europe, and in Asia. Good performance in Q3 in Asia for that particular quarter. Every quarter is slightly different. In Q1, we saw really strong core business performance. We saw really strong European performance. So it's a different mix each quarter, but the important thing is to make sure we've got those cylinders alive and well and performing so that we can then manage the business accordingly.
And that's on the revenue side. I mean, looking at what's maybe more stable is the gross margin.
Yes.
So you are around, taking away the one-off kind of income that you had, you were around the 60%. And just to confirm, this is the hardware. I think we talked about this before, but this is the hardware kind of margin where we should expect you to be around ish the 60%.
Yeah, I would say, firstly, I wouldn't say that asset monetization is one-off either. Yes, it skews the margin, but we do those deals on a semi-regular basis, and we'll continue to see those as an important part of the deal mix. So we will continue to see those. But to your point, as we just look at the core business, then I would say, we have a range of 50 to 60. We've been north of 55. We aim towards 60. It's within those realms that we expect to stay.
And what's interesting here, well, not what's interesting per se, but an interesting part of this, which you spent quite a lot of time on the call, is the old key.
Yes.
Because you have as a part of the strategy to move up the value chain, which is what we're talking about here. And maybe starting out, what is old key?
I mean, firstly, we called it all key because it's a fully integrated product that our customers can buy to easily bake into their product. So instead of offering a sensor only where they have to buy other components and do a lot more integration, it's really a turnkey solution where it's really easy for our customers to buy the product and to have easy integration into their product, which then saves them cost. They have fewer components. It saves them complexity, so manpower necessary to create a product, and they need to depend on us less, which is great. We don't want friction in the cycle because that slows them down. We want to give them all the tools they need to be able to integrate a high quality product. And that's really what AllKey does. It moves from being just a sensor in the past to being a sensor with software, with memory, with MCU, even with a secure element in some cases too, depending on what the customer needs. So a complete integrated stack of capabilities. Because
at the moment, I mean, if you look at it, what you're selling at the moment is basically you selling the sensor, more or less.
We have been, yes.
So looking at the customer base or the future customer base for AllKey, is it the people or the companies who are today buying the sensors which you're trying to upgrade to do this? Or is it more about having the base that you have and then adding on new customers which are buying the system?
Yeah, it's actually both, which is great because, as you look at AllKey, and I talked about this earlier, it's about 3 times the revenue for ASP versus a sensor. Yet at the same time, a customer's not paying more for their COGS because it allows them to remove other things, probably to a greater degree, and therefore actually save on COGS and save on manpower to build a product. So they're actually taking cost out of their investment. environment. And so, I think what Allkey allows us to do is actually reach existing customers so they can upgrade and improve their products and reduce their complexity. Plus, we can it opens up new markets for us as well, because there's a greater set of capabilities on board.
Mm-hmm. But is the focus on upgrading current customers rather than to find new customers?
It's both. It is both. I mean, new customers is renowned for being easier. So we just look through our customers. What does the pipeline look like? Are they looking at Allkey yet? Have we got pipeline for it? No. What do we need to do to get there? So we're looking at the mix that comes from those. And we look at it in kind of three ways. We look at which customers, how many of our customers are moving to Allkey? For those that aren't, what do we need to do? We look at volumes, how much of our volume is shifting towards Allkey. And then we look at the overall revenue mix, how much of our mix of revenue is shifting to Allkey. Not all customers will go to Allkey. Some are high volume customers. They like a fast production cycle. They've already baked in a sensor. Maybe they'll get to Allkey eventually, but they'll get there slower than others, if at all. And so it's really just focusing on that level. But at the same time, we don't just want to, manage our existing customer base. Of course, we want new logos in our business too. Allkey opens up new opportunities, and of course, we pursue that.
Because I mean, you mentioned in the report and also on the call that there's a factor of 3 in terms of ASPs for the Allkey versus just buying the sensor. And obviously, if you have customers which you are selling to today and then they are adopting this, we're talking 3x in terms of revenues. So what is the potential? Can you say anything about the potential here? Or is it...
I mean, it's really powerful for the company. We are up. Obviously we're focused on growth. We've really focused on high value market segments with our business. And now we're moving up the value chain within those segments, making it better for our customers, but also benefiting from that value that we offer to them. And so I think about it in terms of the kind of sales cycle or the production cycle. It takes customers a couple of years to build a new product, from getting a dev kit, which we've distributed many of those, to then building a minimum viable product, to then moving to production, to then selling their products on the market. A couple of years. So I think about that transition taking place over that time. However, that doesn't mean we're waiting for 2 years or 3 years before we get the first product out there. We're already starting to see Allkey product shipping. I expect us to see more next year. I expect to see even more the year after that. And I expect us to hit a critical mass in year 3 as well. So that's kind of how we're thinking about the overall shift in our mix towards Allkey.
And if you look at the revenue mix, you say when 3 years in, 5 years in, what kind of numbers are you expecting?
Yeah, I mean, so as you think about that, I expect more than half of our customers to shift over in that time to Allkey. So as you think about that, you can, depending on which of those customers shift, there's lots of different dynamics. Are they the higher volume? Are they lower volume? But about half our customers are expected to shift over to that. If you take the highest possible bar, if all our customers went, we'd see 3x of our total revenue. I don't expect to see that. I expect some of our customers to remain on sensors. Therefore, I expect around half of our customers to shift over, and therefore you can extrapolate from that 3x those customers. What mix does it create? Probably, 60, 70%, something like that. But those are the numbers we're working with now to really optimize which customers transition, how quickly they transition, maintain volumes, maintain margins with those customers, and that gives us the magic mix.
Yeah, because stopping a bit at the margin, because looking at gross margins, I mean, well, staying at the gross margin should be, because you also buy in the components to build the system and then you sell the systems for 3x. But is kind of the 50 to 60% range also viable for the Allkey?
I think so. Yeah. I mean, the number I'm focused on is the number of customers that migrate to Allkey. When they migrate, we expect their volumes to remain consistent, providing they're still selling as much of their product, but this should help them sell more because it simplifies their COGS. So, we believe that we can switch more of those customers. We believe we can maintain volumes with those customers, and we believe we can work within that margin realm that we spoke about earlier. So that has a really positive impact on our growth because we're growing anyway. Right? Selling sensors. Now you 3x a percentage of that revenue, things look even better.
Yeah. And looking at, moving down, because looking at the COGS, most of the development cost for this has already been taken, right?
The CapEx is taken,
and also so there's not that much operating cost that goes down. So the flow through from gross margin and down should also be quite good.
Yeah, it should be positive. I think, I don't expect us to massively increase our GM. I expect us to maintain within that 50 to 60% realm that we spoke about earlier, but to do that on a 3x revenue, right? So therefore over profitability increases.
And you said you have some test kits out.
Yes.
What is the initial feedback?
Really positive. I mean, I mentioned on the earnings call I was out in India recently. I'm out there talking to customers every week, and the feedback's exactly what we've spoken about, which is it just makes it much more simple for customers to integrate the fingerprint and biometric capability into their products and to get a predictable, high quality outcome from it as well. So really powerful. Customers love what we can do with it. And it's not just fingerprint. We have scrolling on there, so you can use it for menus. It's a really powerful product. So the feedback's been excellent.
Okay. And looking maybe at new growth, because this is the core growth, even though it's upgrading to system, it's core growth.
Yep.
New growth is going to be a lot about software. So maybe the partnership with Anonybit, maybe for the listeners, what is Anonybit?
Yeah, so they are a cloud orchestration platform. That means what you can do is instead of storing templates on a device, you can actually fragment them in the cloud and store them in a distributed manner in the cloud. So that means from a single interface, you can connect for any user, if you like. So that's really powerful when you think about the identity lifecycle, when you first onboard somebody, but then when you see them again for authentication, because often onboarding is a silo, packets are dropped, and then when you authenticate, completely different process. So joining those together, but also really importantly on account recovery. People lose devices or forget their password or whatever else, and that's a major threat vector today. That's how Jaguar Land Rover were breached. That's how MGM and Uber and others, many have been breached that way by people phoning up pretending to be a user and gaining access to their credentials. If you enforce that account recovery stage of the life cycle with biometrics, makes it much more challenging to do. So it really de-risks that cyber vector.
And it's still early days, but you have you're part of the Microsoft Entra. What exactly? How important is that?
That's huge, because what we're not looking to do is get a customer to throw away their infrastructure and start again. What we need to do is integrate into what they already have, but to make their life better using biometrics. Many customers use identity and access management, IAM, from companies like Okta, Microsoft, and others. Microsoft's product is cloud product, used to be Active Directory, is now online in the cloud, called Entra. That's for IAM. And so that's a really important organization to be able to dovetail into, because so many organizations use it. So about 720,000 customers use Entra. So clearly, if that's what they've got is their IAM fabric, we need to integrate into that to enable them to use biometrics for across that life cycle, from onboarding through authentication into account recovery.
And again, because I would assume that this is still in kind of a test phase for many of
It's very early.
customers.
It's early days. It's our first issue of that product. So now what we've done is to time our run as we now start to see, early product coming off the conveyor belt, is to now focus on go to market to go and stimulate demand for that product and start to build opportunities. So that's now where we're shifting from creating capability to now going out and monetizing capability.
Because you took on 2 salespeople.
That's right.
In the US.
Yes.
For this product. And how does it work with you and Anonybit? You're in a partnership. Do you kind of work on your own 2 separate ways, and then you sell this product, and then you have a revenue share?
We have revenue sharing, and we work together. Anonybit's primarily in the US. They don't have huge capacity. They're a small company as well. We're globally distributed, and so we work together very closely. Every 2 weeks, I'm on a call with their leadership, with our salespeople, including our business development person, and we talk about what events are we going to? What are we seeing in the marketplace? Which use cases are resonating? Which buyers are most interested? What messaging is most effective? Because we need to listen to those signals so that as we pivot, like every company needs to, we can make sure we're really going for where the demand is. We can do lots of things. So it's a case of us finding out where's the real demand and let's really double down there.
And what's the feedback been like so far for the ones who've been testing this product?
it's really early days. Here's what we're hearing is that many organizations are just starting to wake up to the need for an identity strategy. They realize that identity is a weak point in their cybersecurity posture. They're looking at capabilities like passkeys, but those alone are a set of capabilities that are not a strategy. So they're now thinking more holistically around their identity strategy and recognizing biometrics is really a key pillar of that. We talked to the FIDO Alliance, for example, and they recognize a huge role for biometrics so that we're not just dependent on devices or passwords, etc. That biometrics is a core part of an identity strategy. So we see a lot of demand for what we're doing. It's just a case now of ensuring that we're converting that into opportunity with budget.
And what would you expect? I mean, it's difficult to say in these early days, but when should we expect to see some coming back from it? When should we expect some sales impact? It's this is a startup business, so it is difficult to say. Here's what I would say, and we don't offer guidance as a company, but honestly, I would say we're looking at the back half of next year when we start to see some of those initial projects close. And then maybe on the licensing deals, because that's more of the financing part of it all and using maybe the resources that you have internally. So you have closed a number of monetizations deals, and you mentioned 3 types of deals that you've been looking for or are looking for in the report. Maybe talk a little bit, what are these 3 types?
There's, like, as I said, when I joined the organization, I wanted to look at what capabilities do we have, what problems are out there to be solved, and how do we marry those up? Because it doesn't always mean I have a product, here's a problem, and then I join them together. That's, of course, our core business. But there are also other capabilities that we have. And so we've got some assets that we've discontinued, and we've done a really good job in monetizing those. We've got some assets that are very active, operational assets that we have today that we've also monetized, like the Smart Eye deal at the beginning of this year. And then we have a set of capabilities, and I think about our ASIC team, our algorithm team. These are all world-class capabilities that most people don't have. But other partners out there need them because they want to include high efficacy biometrics in their offer. And so therefore, it's not always, well, give me your product and I'll consume your product in my product and I'll sell it. Sometimes it's at a more partnership level where they're looking to design in capability. And so we can advise them from a services perspective as well as a pure product perspective. So those are really the 3 kind of tiers, the three pillars that I see. But underneath that, those also drive royalties. So we've got a number of royalty deals out there already. Takes a couple of years because, as I said, the productization cycle is about 2 years, and then we get royalties off the back of that.
But would an example of this capability be, for instance, that you would use or some other company would use your internal teams to develop a new product?
That's right. So they would use our ASIC team to design a new ASIC, build a new ASIC, etc. And so that's certainly a services pillar of what we offer today.
And looking at the 3 kind of pillars that you have, and maybe the operational assets and the capabilities are kind of the old assets are I'm sure there's more to do. But let's say out of these 2, where you most
I think the capabilities, because I'm a huge fan of partnerships. I also think about kind of asset utilization, because if an asset's locked up in a company A, but company B wants to do something but doesn't have access to those assets, well then, problems go unsolved. But if they have access to those assets and you can combine forces, of course, there's monetary gain for, partner A from that, from that partnership. I think that's a really nice way to unlock assets and realize value from them. And that's what we've been doing.
And looking at the monetization, look at the licensing deals and then tying it in with your cash position and your cash flow. Do you think that, you had an improvement in cash flow this quarter compared to last quarter and then on it goes. But do you think that these deals will be enough to be able to finance the ongoing needs until you are able to, until you're cash positive?
Yeah. I would say that's what the transformation plan is. Right? There's a reason there are 4 pillars in it, because the North Star is a profitable going concern. So the first one is asset monetization. Absolutely contributes to that outcome. The second one is core growth. Think about what we're doing to move up the value chain on Allkey. Absolutely drives more income and therefore more profitability, and therefore helps accelerate our time to profitability. The third one is slightly more future facing, because we're not just going to stand still and monetize these things and then it's too late when those markets start to taper off to do something else. So we're investing in the future, in new growth, both with our Iris asset and with our identity cloud assets as well. So that's another one that has yet to take off. But you think about your product portfolio, that gives us future growth too. So that will contribute to the errand. But then finally, there's business modernization. That's not about top line. That's about expense management, because we want to get that growth without increasing our OPEX so that all of that goes straight to the bottom line. And so that's also an important pillar to retain rigor over.
So if you look at the business that you have today and you take away the licensing deals and say that they're on top and they're financing some things, but we talk about cash flow positivity here. And then you have the gross margin should be roughly the same. And then you work with the COGS that you have, and you have ways of keeping it constant. But then is the missing part for you to get there, really to get the revenues, to get the revenue growth? Is that kind of where you are at right now?
Our focus is on driving our top line whilst maintaining and marginally improving our gross margin. But I think our gross margin is in a good place. So it's really on that top line growth. And it comes from those three pillars. It comes from asset monetization. That is a perfectly valid element of our revenue mix. It comes from core growth. And in future, it will come from new growth too. So that's what we're focused on executing. The quicker we do that, the better we do that, the quicker we get to positive EBITDA.
And then finally, maybe you talked about consolidation at the call. You showed a chart with the landscape, which was lots of names. What are your thoughts about inorganic growth opportunities for yourself?
We're focused on being a self-funding business, right? That's what we're focused on, is having a really strong going concern. The reason I talk about those things is because it's important for us to look at the bigger picture. Right. And the bigger picture is that customers are being breached, and they're being breached at ever increasing magnitude. I gave an example on the call today of Jaguar Land Rover, the biggest cyber attack ever in the UK in terms of its impact on a company, nearly £2 billion impact on that company. And it's a problem. And it's because identity is the threat vector there. People stealing credentials or even buying credentials from insiders, lots of different ways that they can gain access. And so identity is at the core. So the way I see it is that identity, the market is moving towards identity-centric security. Identity is the perimeter, as they say. So security surrounds you as opposed to locks up your data vault, for example. And so there's a big opportunity in the space we're in, because that's where breaches are happening. But if you look at the overall market and the vendor landscape, super fragmented. Lots of subscale, lots of small niche vendors all doing their bit, but they end up with locked up assets where they can only serve a small community. I believe there's an opportunity to roll up and aggregate some of those capabilities to be able to offer a customer a more holistic solution. So a bit like Orki, the customer's not having to piece it together with that, wearing the complexity and cost and risk of doing that, but offering them a more holistic solution that goes across the entire identity lifecycle and offers them security in depth as it relates to identity.
Adam, lots of things going on.
Always.
Lovely to talk to you as
Likewise.
always. And thank you for listening.